Hello, this is George Beyrouthi from FS Securities, a stockbroking firm on the Gold Coast in Queensland, Australia. Today I'll show you a trade on Flight Centre. It's actually a stock that we trade on the Australian market, and we may get you to have a look at to trade if you wish. I will use fundamental and technical analysis to come up with a recommendation. Of course, you will need to talk to us or to your professional advisor before you trade or invest in this particular stock. And I'd like to actually mention to you before we start that if you're trading or investing and you believe you need a hand to evaluate your portfolio and wish to learn how to pick signals on what to keep and what to hold, we run an education program tailor-made to suit your needs. So now to the Flight Centre. Flight Centre company is actually a travel agency business, and it provides complete service to the travelers, and they are not only the corporate travelers but also the leisure travelers. And they're not only in Australia, but they are all over the world. They've got offices all over the world. And so first of all, let's look at some fundamental issues here. The company is worth approximately on our stock market around $5 billion, which translates to more than $3 billion US. The price earning ratio is around the market value. It's about 16.7, and the particular sector, which is the consumer services here, is actually slightly above it. One important thing about the price earning ratio, the price earning growth, the PEG ratio, is actually the ratio that confirms whether the PE is overpriced or not. So PEG is not as comprehensive in measure as the aspect value rank. However, it provides a good indication whether the price earning ratio is actually well priced. And usually level 1 indicate a fair value. If it's well above 1, that obviously it shows maybe it's a bit more expensive. However, when the interest rate is low, it is actually accepted that the 1 can be increased above 1, and the price earning ratio can be a bit higher than the norm. Now, the other thing I want to talk to you about is the dividend stability. This calculation is designed to assess the probability of a future cut in dividends based on the company historical dividend payments. So if the percentage is around 100%, that indicates that no dividend cuts had been recorded in the past. Well, most companies actually from time to time will reduce their dividends. So 92.5 is actually better than the market and slightly below the sector. So I think it's still a relatively good dividend performance. And here we see that coming up on the 21st of March, the company is going to provide an extraordinary share dividends of nearly 209 cents, and that will be represented by nearly 4.6%. It's a special interim dividends, and of course if you buy it today or well before the ex-dividend date, you're going to get $2. Of course the price of the share will drop as well, but we're looking at the long term whether the share can actually increase above what it is right now. Okay, we have a mechanical system which I designed over the last 20 years, which make a forecast strategy unique for the investor and unique for the traders. And even for the trader, we make differentiation between the conservative trader and the aggressive trader and the very aggressive trader. Did that only 24 hours ago, and you can see for the very aggressive trader and the aggressive trader, we have a bull signal because you are into the market much earlier than the investor. The investor wants to see a lot more solid data and more confirmation that the bull market will continue. Of course, the investor is not interested in finding out where the ground floor is or where the penthouse is, but somewhere slightly above that advice, we can say that still a good trade for the very aggressive and the aggressive trader. If you want to see what happened over the last 50 weeks, the market went from 100% where it was, went up another 20%, and then dropped from the high down to the bottom. That's nearly 50%. So it's actually almost half the price for different reasons. And now it's starting to climb up again. So that's for the last 4 or 5 weeks. We can see that the market zigzagging upwards and there is a momentum. So these are the figures over the last 4 weeks. It closed at 45.77, a week before 45.18, 44.90 and $43.13. So for 4 consecutive weeks the market is being very excited by what Flight Centre is offering the market in terms of dividends, special dividends, and expected profit in the future. I want to start with the long-term view of the market. I'm going to start with the 200-day moving average here, which is actually the black line, and also we've got the 100-day moving average and the 50-day moving average. Looking at the long-term view, the 200-day moving average, which covers the previous 40 weeks of trading, is commonly used in stock trading to determine the general market trend. As long as stock prices, that's the candles or the bars, remain above the 200 simple moving average or below it on the daily time frame, the stock is generally considered to be an overall uptrend or an overall downtrend. Now the crossover between 2 long-term moving averages, we call them moving averages crossing over each other. A golden cross is considered a bullish sign. It occurs when the 50-day moving average rises above the 200-day moving average. And we can usually start to see that by the 50-day moving average crossing above the 100 and then getting up to the 200 and crossing above it. Well, this is a long term, and you can see here why the investor at the moment is sitting on the sideline. And even for the conservative trader, he's waiting for those candles to actually get a bit higher, and hopefully the 50-day moving average will cross above the 100 and start to converge towards the 200. Now looking at the medium term, and I'm going to take you onto 3 different indicators that we use. I'm going to start with the stochastic here, and I'll tell you the stochastic indicator is a momentum indicator. It really shows whether there is a positive momentum or otherwise. It shows the position of the most recent closing price relative to the previous high-low range. So if you take 14 periods, it can be 14 weeks or 14 days or 14 months. Within the 14 period, there is the highest high and the lowest low. The highest high is 100%, the lowest low amongst the 14 period is 0%. And then the last closing price is represented in percentage between the 2 range. And as that moves over and over every period, it will either climb up or climb down or move sideways. And here you can see the blue line. We can see it was down very close to 0. That's really very bottom, and started to climb above. And now it's almost halfway between the 2 range. We've got 2 lines here, the 25 and 75. And we think that if it goes above the 75, we confirm the bullish trend. And if it stays below that 25 lines, it is confirming and will stay below that line, which means we are bearish. It crossed above it and continues to move upward. So that's very bullish. Now in terms of the crossover, here we've got the black dotted line is 21 week moving average, because this is a weekly chart. We can actually use it for the daily chart and it will be 21 days. But here is 21 weeks and the orange line is the 9 weeks. And every time we see the orange line above the 21 week, that's bullish. And you can see all the candles happen to be above, and then bang, it goes down, and a couple of weeks later the orange line crosses below and confirms the bearish trend, and we started to see a convergence, and we may hopefully see that orange line for the medium term on the weekly chart crossing above the 21 week moving average. The parabolic stop and reverse is actually a tool to find price reversal. It is a very leading indicator and tells us when we expect a reversal from bullish to bearish. It's a parabola and it's got an acceleration factor. Without going too much in details, for those people who are not used to charts, all I want you to focus on, as long as those red dots happen to be above the candles, we are bearish. When it's below, we are bullish. And guess what happened the last 3 weeks? These dots start to appear below. So that's a good sign. So the stochastic is bullish on the weekly. The parabolic stop and reverse is bullish. However, the crossover has not really formed into a bullish indication. So out of 3 indication here, we have 2 out of 3 bullish and 1 bearish. I add an extra indicator. It's called the MACD. It's a trend following momentum indicator that shows the relationship between 2 moving averages. And when the blue line is on the up way and above the orange line, that is actually bullish. And by the way, as I mentioned, we run courses and we teach people how to look at charts and able to pick up those signals and make a logical decision when to get in, when to get out of the market. So without that, I am pretty sure from experience, having seen so many people getting in the market and not knowing when to get out, they get burnt and then eventually they get out at a greater loss than usual. So the MACD is another bullish indicator. So far we have 3 out of 4 bullish and 1 bearish. Here we got a DMI, and the DMI is a trend trading indicator, and it is based on a scale from 0 to 100, which identify whether the price is overbought or oversold. In this particular case here, we can see this is a bearish indication because the blue line is below that orange line. So this is a bearish indicator. So far we have 3 bullish and 2 bearish. Last one, the RSI, and this is actually moving upward, and the RSI has become one of the most popular oscillator indicator for traders in financial markets. This momentum indicator can fluctuate between 0 and 100, providing overbought and oversold signals. When it's above the 75 line, it's overbought, but it doesn't mean that you sell. You sell when that line, the blue line, crosses below that horizontal line. And when it's below that horizontal line at the bottom, we need to see that line crossing above it. And by the way, it hasn't really crossed below that horizontal line at the bottom for much lengthy time. It went down to it and then picked up again the steam. So it really shows that there is a momentum. So here we can see then that we've got 4 bullish and 2 bearish, and we need another 1 bullish to confirm that on the medium term that we have a bullish trend, because we have 8 indicators that we use and we must have 5 out of 8 before the signal is confirmed. I'm going to jump into the daily charts. So we almost have a positive momentum on the weekly, and now if we end up having 5 bullish indicators on the weekly, the signal is given to the daily, and now we need to find 5 positive indicators on the daily chart to confirm that we are able to trade. So we're very close to the weekly, and now we look for 5 positive bullish indicators. The crossover, the orange, is above the black, that's bullish. The parabolic stop and reverse is bullish. The stochastic is bullish. And guess what? We look like we're moving in the right direction as an indication that we might take this further into a further analysis. And what we will actually end up saying, that the last thing that you need to know, if we decided to go into the trade, where are our targets and where is our stop loss? Our stop loss, if we get in at 45 on Monday, and if it falls and we are completely wrong, we want to have a stop loss around the 42. If on the other hand we are correct and we're heading upwards, the first thing I want to see is that gap being closed. So I want to see the 47 being triggered, and then the market continues to move above it and test the last peak, recent peak, at the $50. And if it gets to $50 from 45, within say a few weeks, I would say you've made 10%. However, remember the dividend will be paid on the 23rd, and that will push the price down by $2. I think it will go up to 47, maybe higher than 47, and then drop, and then move sideways, and then continue its journey. So it may be about if you put the $2 in your pocket and wait until it gets to 50, you would have made more than 10% return. At that time, if it gets to 50, then I would recommend you close about 30% of your trade and leave the other 70%, and hopefully we'll get to the 52 or 53. So in the summary, we recommend a buy strategy for the aggressive and the very aggressive traders. And if you want more advice, please call us and talk to us, and we'll give you some indication about how much money and what sort of percentage of your total portfolio you should put into this company. Okay, so finally, I just want to say to you that you need to actually talk to us, and hopefully you will be able to get a good recommendation from us. And that's all from us here at FS Securities. Please trade safely and wisely, and have a great day.